welcome again. My name's Charles Kinsella and I'm joined here with Lou Caldararo. Today we're going to be talking about how customer credit risk impacts your bottom line. Lou joins us as the National Credit Manager at IMCD and has over 30 years experience as a credit professional. He's the former director and board member of the Australian Institute of Credit Management and is a part of 14 credit bureaus, which are industry and practitioner specific. So Lou, welcome. I can see you're in sunny Melbourne. We have a beautiful rainy day here in Sydney. Great to have you with us today.
Yeah, thanks, Charles, for having me. I greatly appreciate it. Thank you. And yeah, you're right. I thought I'd just put a fantastic backdrop. It's not AI. It is live backdrop.
In Sydney, I'm not sure what the blue looks like. So look, we'll kick off. There will be a poll that will be posted shortly. I'd encourage all attendees to respond to the poll, as that will help Lou and I talk to one of our topics later on. And there's also an opportunity to submit questions. If we have time at the end, we'll do our best to have a bit of a Q&A. But let's kick off, Lou. So today, for those that are new to joining one of the CreditorWatch webinars, we're going to have some of our customers joining us, as well as people that are new to the business. A little bit about CreditorWatch. So our purpose is to empower Australian businesses to trade confidently with their customers. Founded in 2010, one of the key selling points for CreditorWatch and our customers is our unique and growing data sets and our industry-leading platform. Touching on our unique data, there's a lot of common data that you'll see with a lot of different credit bureaus. However, from a CreditorWatch perspective, what really brings our data across the line is that payment default, mercantile inquiries, CreditorWatch inquiries, as well as our accounting and corporate ATB data. So what will we be covering today? 5 subjects that Lou and I will be discussing. The first will be underestimating insolvency risk. We'll then touch on the ATO tax default data, weak credit applications and supplier agreements, misusing or ignoring AI and credit risk management, and then the importance of monitoring customers over time. So to kick this off with underestimating insolvency risk, we'll start with a little bit of an economic outlook and business conditions. In 2022, we saw the economy and businesses adjusting to the imbalances brought through by COVID. We saw the end of lockdowns, permanent reopening of borders, which led to a lot higher interest rates. One of the things that we're really seeing now, despite inflation moderating, the cost of living and the cost of doing business has not fallen. And what we're seeing is that's putting a lot of significant pressure on consumers, budgetary discretion spending, and slowing population growth, as well as an impact of Trump's tariff policies, are also becoming more and more relevant. So as I mentioned, we're seeing insolvencies remain elevated, but they have moderated. You can see there over the last couple of months, it's staying high around 1,200. What that is also being spurred with and is in line with is the B2B trade payment default data. So Lou, a question to yourself is, do you feel that are you feeling that this is moderating, or and will eventually reduce down? Or is this a part of the new normal?
Charles, I think it's the new normal out there at the moment, because insolvency is obviously on the increase. We're still sort of feeling the effects of the COVID sort of zombie dormant environment that a lot of the companies are facing, and it's just all coming to a head. You said that ATO been quite active in this area as well too, with the payments and the defaults that have been listed with the customers or the companies. So I think I think it'll be the new normal. And sadly, in my view, I think it'll probably get worse before it gets better.
Yeah, some interesting data just around trade payment defaults and its correlation to insolvency rates. We're seeing that from 0 to 1 to 2 to 3 to 4 payment defaults, the impact and increasingly likelihood of insolvency is going up to 25 to 40% there. So at the moment, with that moderating and not dropping, I think it is the new normal for a while. It's interesting though that the lower interest rates is not having an impact in reducing it, but more so just leveling it out. Lou, you touched on the ATO tax default data. That ties in nicely to what we're going to look at now. This is relatively new data from a credit professional point of view. As you can see here, in October-ish 2023 was when the ATO made this data first publicly available. There was a lot of ATO tax defaults registered that had a significant impact on a lot of businesses. The parameters for these to be let out is over $100,000, and that the business has not entered into any sort of payment plan with the ATO in order for it to be listed. Down the bottom there in the darker gray, you can see that once a business does enter into a payment plan, that default needs to be removed and is completely removed from their credit file, gone without a trace. So there's quite a lot happening here when it comes to the volume that's coming through. From a CreditorWatch perspective, and interestingly, 16,000 of these are sole traders. This sole trader data is only available on CreditorWatch, and of those 16,000 sole traders, 45% of them are in construction, residential construction especially. The impact of an ATO tax default on the insolvency rate of a business, as we can see here, is quite significant, right? Average 15, 16%, up to 40% on industry-specific businesses, the likelihood of them being insolvent within the next 12 months. Lou, with 30 years experience, however, being only having access to this data for the last 3 years, how are you using this data, and what's the best practice?
Yeah, thanks, Charles. I mean, look, for a credit professional, for me too, this is the first warning sign there's potentially an issue with, obviously, with the customer that haven't paid the tax debt, okay, especially in that sort of SME market. So from a credit manager point of view, that to me sort of prompts an instant review of the customer's account to see, one, how they've been paying us, and to look at, you know, sort of where we go with these customers from a credit risk management point of view. Albeit it could be all bubbling along quite dandy, but the problem I see is that at any given time, you know, if the ATO decides to instigate a directed penalty notice to the customer, then, you know, it's only going to go downhill from there. So you don't want to be caught out, okay, you know, knowing full well that there's an issue with the customer. So I'd prompt a review of the customer's account straight away. Removing the tax default off the credit reporting agencies, it's a bugbear of mine, is because I find that, you know, if I review the customer, great, and I think we touched on the customer monitoring down the track a little bit, but I find that as a bugbear, because I want to know, if I log into any of the your credit reports, that there's a tax default. Once that's removed, it's gone. So it makes it very hard to make a proper assessment of the customer's credit worthiness with that data going, because they could be paying suppliers, okay, all right, that's not an issue, but they've got an ATO tax debt looming in the background. So yeah, that's a sort of bugbear of mine. But anyway, until legislation changes, I think we're stuck with it for the time being.
Yeah, and look, at the moment, the debt has to be over $100,000. So there's probably significantly more amount of tax defaults not going registered at the moment, which would be, again, something that would be very important for a lot of suppliers to be aware of. But it also touches on, you know, as you mentioned, like the importance of monitoring, that we'll talk to in a minute, as it's gone, it's gone. So, you know, it's on your team to be able to capture that and sort of, you know, make a note of it at the moment.
Correct.
Moving over to weak credit applications and supplier agreements. So look, as a part of the business, things go wrong, businesses go south, and bad debt is a part of doing business. However, when that happens, the importance of having a credit application, a supplier agreement, or a contract in place that you can fall back on, whether it comes to an insolvency practitioner or the courts, is so important. Lou, you've got a lot of experience when working through these, having to lean back on them, setting them up. Lou's kindly put a few key considerations and best practice for us to talk through. Lou, I'll throw it over to you to talk through your key considerations when looking at supplier agreements and credit applications.
Yeah, Thanks, Charles. So let's start with the first one, right? Get to know your customer. Okay, that's the first and foremost. Make sure you're dealing with the right legal entity. I mean, that's and the only way you're going to get that information is either through your credit application, all right, completed, and then verifying that with your credit reports. Because the last thing you want to do is go to court or get to the stage where you see your lawyer and say, well, hang on a second, you're dealing with ABC, but technically you're dealing with EFG, company proprietary limited. So that's why it's really important. You need to make sure that you know who you're dealing with, and obviously verify your information through the CreditorWatch credit reports. That way there you know who the directors are, who signed for the credit application as well too. Has that person got the authority to sign on behalf of the directors? I'd like to see all directors sign the credit applications, then to make sure there's no ambiguity. A worst case scenario, I know who I'm dealing with, and I know who the person who's going to pay the account is the person that's authorised that transaction as well too. Coming to up-to-date terms and conditions or T's and C's, I think that's important to make sure they're current. There's always been changes in legislation like the unfair preferences. I think that happened in November 23. That needs to be considered, but they're up to date, they're current, and they're modern. And make sure you tell your customers about the changes as well too. I think that's the other key point takeaway out of all this. So it's pointless just changing terms and conditions without notifying your customers. So it's important that you do so. Now coming back to, I think this is the more challenging part of it, and it's become more prevalent nowadays, is supply agreements versus T's and C's. If you've got a good set of terms and conditions and you've got the special clauses in there, or not special clauses in there saying any variation to T's and C's need to be put in writing and accepted in writing, okay, then your T's and C's should prevail. Okay, so, but we are getting more and more sort of customers saying that we don't want to sign your T's and C's, and we want you to complete our supply agreements. We've got a myriad of terms and conditions in there that needs to be considered and looked at. So my suggestion is to read them, understand them, don't overlook them, because at the end of the day, you potentially could be out of pocket, especially in the warranty and the liability side of those supply agreements. And if you don't understand them, get advice. I mean, there's no harm in that, because all your companies should have a policy and how to deal and manage with those particular agreements. I think because that's important to understand that the potential liability in the future. I keep saying terms and conditions and these agreements are not for today, they're for tomorrow. Just in case something goes sour, you need to make sure you protect the best interest for your company. Awesome, thanks, Lou.
From a seek advice, sort of out externally, we're going to have businesses of all sizes dialing in here. Where would you suggest external advice?
Look, it's always best to seek a lawyer, sadly, advice, because they should guide you through it. But even though, your accountants should be able to also give you advice on it, see terms and conditions. But even AICM, through the Institute of Credit Management, they can sort of guide you to some channels, and I'm sure Charles with CreditorWatch can also give some guidance in that area too. But look, at the end of the day, it's a legal contract. And I guess the best advice you probably need to seek is from a lawyer, see how you're going to manage it. If you haven't got internal counsel, you probably need to get an external view on it.
Yeah, agreed. Moving across, so misusing or ignoring AI in credit risk management. Thank you for everyone who completed the poll. Just having a look at those results now. The reason why we've put this in here is it's top of mind for a lot of people, and I think it's taking a slower approach of, how does this look? What does AI in credit management finance look like? And also, should I be approaching it now? Should I be holding off early adopters? There's a few different ways that people are considering looking at it. The poll results there are quite interesting. Lou, AI in the credit industry, I know it's top of mind for a lot of people over the last years. A lot of people aren't fully understanding where it takes place. Some might be a bit threatened. Is this something that could potentially replace me? I know there's a lot of industries that are quite well worried about that. Interested to understand, your key considerations and approach when it comes to AI and how it might be applicable in the credit management industry.
Thanks, Charles. Again, yeah, look, some of the points I've put here is, look, don't be fearful of it. Okay, that it's not here to take your job. Okay, that's why I look at it. I embraced it very early in my career when it first introduced, some 10 to 15 years ago, I think, when the sort of first AI came out. Now we're not talking iRobot like the Will Smith movie. Okay, that I don't think will happen in my lifetime. But look, automation is certainly the key takeaway here, is that you need to. We're doing more with less. Okay, so that's where most credit managers have faced themselves. We're getting very tight with manpower, and we're getting bigger ledgers to manage and control, and the tail end gets very long. Okay, so you need to look at how you are going to manage that. Okay, so a couple of points I've put here is that credit applications. Okay, so back in the old days when you had to put dry ink on pen to paper, it used to take 2, 3, 4 weeks to get a credit application through the system, and that's looking at sort of alterations, changes, having a discussion with the customer, the account managers, saying, well, do or don't we accept the alterations, and where I would reject them all and tell them to get completed in its entirety. AI's put a different perspective on that. It basically means that I can have a credit application process within 24 hours of it being completed from a customer point of view, so from service level, from an SLA point of view internally. Okay, the account managers are thrilled. Approvals, setting parameters, that we use that sort of dynamics within the credit processing. So if we set the parameters up in the system, okay, it'll either accept it automatically, go through the system, get it updated into our current ERP system, or if it's been rejected or referred to the credit controller, then they can make a decision on what needs to be required, or if not, refer to me for a further decision on the particular applications. And the beauty about the AI or the automated process as well with credit apps, there's no alterations, okay, because you got to go from page 1 to page 10 or whatever how big your application is, without alterations, so they can't change your terms and conditions. They either have to accept them or they don't. Okay, that raises another issue then with the customer, but at the end of the day, an account's a privilege. That if you've got it and you want terms, you supply it under our agreements and move on. The other part of it is.
Sorry, Luke, just from the credit application, like the impacts to the business there, and how I think you were speaking previously, that faster turnaround time can really have a direct impact on revenues when it comes to being able to allow customers to start purchasing sooner. I think you were talking about previously.
Okay.
It was 2 weeks,
right.
cut in half, or even a day.
Yeah. Oh, definitely. Yeah, look, it just means sort of more revenue, quicker revenue onto our books as well too, and the right revenue as well too, because we want to make sure all the boxes are ticked, so there's no adverse information. And as we touched upon earlier too, Charles, I mean the credit reports. Okay, that's always handy to review and look through any potential issues with them. I guess the next one is collections, more coverage of accounts. Okay, definitely, because with the automated process there, you can sit there and work through to the tail end in the flick of a switch. Okay, basically, I know I'm a bit flippant about it, but you basically flip the switch. You've covered your bottom end, your customs. Now, on average, if a credit controller, credit officer is managing in between 500 to 1,500 accounts, it's impossible for them to call the customers or make contact with them. So I think that's definitely been a positive sort of change to the whole process. And it's a reminder, and it's the old adage, squeaky door gets oiled first. I mean, if you get reminded, okay, oh yeah, triggers the memory, get paid. So you need to, but you pay your account and, you get stock. That's it, full stop. It keeps the whole process happening.
Yeah, and also, look, a lot of your customers, if you go by the 80-20 rule, the 80% of them can be higher volume, but lower amount and lower value, and they might be almost trained that they need to be prompted or contacted before they pay. And that's just, look, time efficiency point of view, being able to focus on that top 20% and your quality large customers and creating better relationships is going to have a much bigger impact on your DSO, your overall cash flow. But unfortunately, because if you've got a smaller customer base that's lower revenues who are just used to you calling them, having AI potentially take over that can free up a lot of your time, but still keep that cash coming in with the lower segment accounts within someone's customer book.
Oh, definitely, and that sort of leads a great segue into my next sort of comment there with credit reviews, where I prefer my team to focus on, on the credit worthiness and problematic customers that we may have on our books, and I certainly want them to be focused on those because they potentially could cost the customer, or sorry, our company dollars, okay, in possible delayed payments or potential bad debts. And I prefer them to spend their time, with something looking at those customers and coming up with recommendations, what we should and shouldn't do with them, okay? Because at the end of the day, it's all about sort of being efficient and sort of protecting the company's interest. And then for that, with all the time and energy you sort of save with those automation processes, you spend more time training staff and educating them. Look, I'm a great believer in educating people. I've always said to any of my staff, if you're good enough to take my job, I'm happy to teach you. Okay, if you're good enough to knock me off the perch, well, good on you. I'm happy for you. So look, I've had the great pleasure of educating staff and now seeing in national roles over the years, and from a credit professional, sort of just makes you feel good when you see those people up there, so that you've seen them sort of come through the ranks. As a credit officer or credit controller, now they're sort of leading some very large, credit portfolios.
Well said.
Yeah.
Moving to our last overall look to credit risk factor, but I think it's probably one of the most commonly overlooked, is the monitoring and why alerts are just essential. Lou, we've spoken about know your customer, understanding contract. At the moment, it's not a complicated and expensive process to set up a new business, right? Understanding who you're dealing with while you're dealing with them is so important. One of the things we see very often is when we bring on a new customer to CreditorWatch and we do a data wash of their full customer base, generally between 10 to 12% of their ABNs or the ACNs that they provide of their active customers are actually cancelled or deregistered. Right, a new business has been set up. They might be dealing with the same people. They might be sending stock services to the same locations, but ultimately it's a completely new entity, and it's just something that not a lot of people are aware of. I believe the market and the industry has grown as far as everyone is doing more and more credit checks before they start dealing with them. But Luke, can you talk about the importance of just staying up to date when you're actually exposed and you've extended credit to a customer?
Oh, look, I want to touch upon data monitoring, and then you've hit the nail right on the head. We moved into a new ERP system about 3 years ago, and I had old legacy data that I inherited, and I said, well, I'm not going to do anything about it because I know there was a lot of errors in there. And exactly what you said there, Charles, is that I moved them across to the new ERP system, did a internal data wash, so to speak. But the problem I had there is, am I dealing with the correct legal entities? Okay, so we did this exercise with CreditorWatch probably about a year or so ago. Okay, and we data washed our customers. I knew that some data was wrong, and I had to make sure I corrected it. So we did a massive data wash earlier this year, okay, with all our customers. And you're right, we found that we were dealing with customers that allegedly that we had them linked to an ABN or an ACN that was incorrect. So we did a data cleanse, fixed it, cleaned it, and then started monitoring those correct customers. The last thing you want to do is monitor a customer you don't have on your books, okay, or you have on your books and you're monitoring the wrong customer. So that's why I think it's important you do so, to make sure you wash that data correctly and know who you're dealing with from the start. Very easy with a new credit application, very hard with the legacy data. Okay, that's what I found. So got it washed, got it clean, brought it up to date. I know who I'm dealing with. I'm monitoring the correct customers, And by monitoring the correct customers in the event there's any adverse information, either through ASIC, I know you got everyone does their data wash through the ASIC database, and they get the collective information. But what I also find important from a credit risk point of view is any defaults, as we touched upon earlier. Okay, that may come up through your data, and to me that's the first warning sign that there's potential issues, regardless what the issue is, right? Okay, it's a default, so no one hasn't paid their account, so we review it. Right?
Yeah, especially if it's an ATO tax default that we touched on that will disappear, right? So you could be dealing with a customer, and although they have entered into a payment plan with the ATO, it doesn't mean they're out of the woods yet, and we've seen that direct correlation to a future insolvency. So you might actually miss that if you're not monitoring as well.
That's right. Well, that's one part of it, but the members do also monitor or default list customers. Okay, and that's on there. Okay, and you don't remove those. So as I said, they're my trigger points that I sit and need to review the customers, and the teams across that. Okay, once they see that, it's a instant review of customer to say, well, okay, how are they performing with this? Is it worth it? And look, if it's a small account, we might just let it sort of bubble along. But if it's an average to large customer, we'll sit in and do a review and look at any potential risks, or how do we manage that account.
Yeah, we also have a lot of customers of ours that, they are servicing and providing goods or every day. The ability to act quickly when it comes to a potential administration, insolvency, a company being wound up, allows people to really reduce the amount of exposure that they have, knowing potentially they might be secured or unsecured, that anything they continue to service or ship out might be cents on the dollar.
Oh, definitely, and especially now with the SBRs is the I guess the critical one here. Unfortunately, if it's an administration or liquidation, if you haven't got your perfected PPS, then you've got some issues. But the other sort of key takeaway, I guess, from this is once an SBR or the small business restructuring has taken place, they can still trade, and they can be selective who they trade with, and they can be selective with the information they supply to their suppliers. So that's why it's important to get that information very, very early to potentially stop any further bad debt exposure. So that's definitely one on the key on the key highlights that you need people need to be mindful of.
Lou, that brings us to time. I just wanted to say a big thank you for your experience and knowledge that you've brought forward. I really appreciate it. And to anyone that has any further questions or would like to chat to CreditorWatch, or even further questions for Lou, he's a part of 14 credit bureaus. He's an extremely accessible person who just cares about the industry a lot. So look, thank you so much for joining us, mate. And if anyone has any question, please feel free to reach out.
Thanks, Charles. Greatly appreciate it. Thank you for the time.